best opportunity in storage today, possibly one of the best opportunities in commercial real estate today. A lot of instances of a deal gone wrong is not operator error, it's 1 in 11 households were consumers of storage. There is this inflation hedge that comes with storage because it's a month-to-month lease. Having an opportunity to look the operator in the eye as an LP, to get to know them, like them, and trust them. Storage is an incredible asset class. A bad operator can turn a good deal into a pile of garbage. A great operator who has the grit to push through those difficult times, finding the right operator in storage is the same as finding.
Hey everybody, welcome to the Fundication Show. I'm Julie Tallman, and as always, we have Christian Sadler, the host.
Hey everybody.
Pre-iShare and the Fundication Show just had a fantastic week at the Best Ever Conference, and we were able to snag Mr. Ben Lapidus.
Got it.
From the Best Ever Show, host of the Best Ever Show, and just formally retired from Spartan Investment Group as the CFO. Mm-hmm. And we have so much to digest about the show and passive investing, and we also just want to grill him about storage, something we don't get a chance to nerd out often, and we have just the right person to ask questions. So thank you for being here. Welcome.
And thank you, Julie. Thanks, Christian, for having me.
Absolutely.
Appreciate
Absolutely. Glad to have you here. And of course, again, this is kind of the best ever conference episode of the Fundication Show. This is our first time. We missed it last year. It's here in our hometown. We're grateful for that. I would love to understand the story behind Best Ever, though. I mean, how did it all begin?
Yeah. So I've always been an entrepreneur. I went to school during the GFC, Global Financial Crisis. I thought I was going to be an investment banker. Did that for about 3 months right after Barclays bought Lehman Brothers, and I got to sit on the exotic credit derivatives desk, watch all that bleed off the balance sheets. So it was fun being in the center of history there, and realized that was not for me. Started a study abroad company in Costa Rica instead at 19 years old. When I sold that at 22, I had some cash, and I met Joe Fairless, who is the founder of the Best Real Estate Investing Advice Ever show from 10 years ago now. And he had just finished his first syndication of multifamily, and we became friends. He walked me through his approach to syndication. This is before it became a popular word. This is before the Jobs Act in 2012 was even passed through Congress. And we became good friends, both doing advertising technology and real estate on the side, living in New York City. He ended up moving to another town to work on his multifamily syndication. And when I decided to move from New York to Denver, I said, hey man, I would love to put myself in a position to meet some great people. I have this event experience from doing the study abroad company. You have this show where you know all these people. You're doing a daily episode. You've interviewed 500 people. You've got listeners. Let's turn it into a conference. And he said, great, I just put that on my vision board last month. I haven't done anything to accomplish that, but it's on my vision board. So that was the impetus for the Best Ever Conference. And we had our first one in Denver in 2017, where I lived. And that town was much less receptive to that conference than Salt Lake has been. So over the next 5 years, we grew that event, brought it to Salt Lake after COVID, allowed us to be back in person, and here we are. I think what's differentiated the Best Ever Conference from other events is there's no peek behind a magic curtain that shows you how to get rich quick in exchange for a $100,000 fee. Rather than a how-to coaching place, we've got nothing to sell, no gimmicks, no fluff. It's a trade event. It's like being in a plumbers association and going to a plumbers trade show. You are in a syndicator association and you're going to a syndicator trade show where operators who syndicate cash can present their deals, present their deal flow, present themselves, present their teams, and LPs who are active in managing their portfolios can meet those folks. And it's worked.
Yeah, very cool. And I feel like there was so much collaboration within the group, and I think because of what you're just saying, a lot of people there are real estate syndicators, but then of course you have the passive investors that want to know what investments out there, what operators there are. And so there's this interesting mix of people who have capital they're looking to deploy, and then people that are operators that are looking for capital that they can put to work.
Yeah, and I think it's that immeasurable quality that we have of collisions per capita. That's how we think of success. How can we get more quality interactions to occur in a contained, exclusive space? And I think by concentrating on that, we've created value for the community on both sides, the LPs and the GPs.
One thing I noticed and was a reason that I told you Best Ever was my favorite conference so far is that it was so non-threatening. You had GPs that were fantastic operators talking to an entry-level LP just saying, just let me know how I can help. You know, there really is a community of ever-changing, ever-evolving, and syndication is coming out of nowhere and blowing up. And so, yeah, you do have to educate yourself, but there's so much opportunity. So we appreciate the mix.
Yeah. It's a great event. I have fun every year, and I'm always excited to meet new people like you guys. Got to meet you guys for
And
the
if
first
we're
time this year.
lucky, you said BEC will be in Salt Lake City again next year.
Oh, you're more than lucky. You're locked in. We're going to be in Salt Lake next year. Oh, yeah.
Nice.
Yeah, I love it. So Ben, in the beginning, seems like it was probably a lot of work on your end. Talk to us about the kind of the evolution of how the how it started and where it's at now, because it seems like such a big production now, and there's so many moving pieces. You have some great team members who have been super helpful to us. Talk to us about that evolution.
Yeah, sure. So it was never meant to be a business. It was meant to be a facilitator for relationships and networking, both for myself and for Joe. Wanted to build it such that I was the audience avatar. Only put people on stage that I would be interested in learning from. Make sure that they aren't trying to sell me and they're not trying to sell the audience. They're just there because they love giving their content, their wisdom, their knowledge, their experience, and maybe something happens off stage, off conference as a result of that. But that's not their core intent for being there. So it didn't start off as a money-making scheme. It started off as just a desire to be surrounded by like-minded people who were also filtered and not maybe going through their first experience, people that I could learn from and perhaps they could learn something from me. And so our first event, Joe was the megaphone. He had that podcast and he announced, I'm doing this show in Denver. If you'd like to meet me, I'll be there. And if you'd like to participate, we're going to have all these other speakers. We had maybe 30-something speakers that first year. We had three sponsors. And I think it was like $2,000 in sponsorship per sponsor. And we had about 150 people in attendance. Next year, we did it again. 350 people in attendance. The next year, we had about 575 people in attendance. So I think that folks were coming away from it and saying, oh, this was useful. And it was non-threatening. I could be vulnerable. I could share my success and not be kind of naysayered by other people that were threatened by my success. And I could share my failures and be uplifted and supported by those around me who are saying, you're going to figure it out. You're going to get through it. As an LP, folks were finding good opportunities. I mean, granted, back in 2016, 2017, almost anything that you put money into was doing well. But regardless of that, having an opportunity to look the operator in the eye as an LP, to get to know them, like them, and trust them, that has, at least for me, I'm an LP as well, right? And I don't invest in anyone that I haven't had a chance to look them in the eye and get to know, like, and trust what they've done. The only times I've ever lost my money in somebody else's deal is when I haven't met the person in charge of how that money gets allocated. So that's become a rule for me. So this conference has become that safe place for LPs and GPs to talk about real life things that maybe isn't shared as much on the facade of a business or the facade of a relationship between an LP and a GP.
I think some of the best GPs, like you said, are LPs. So they have to flow back and forth between those two positions. And I do want to kind of transition and talk about storage, because we met so many people who said, I'm interested in storage. I've heard it cash flows really well. I've heard it's easy to analyze, but people are a little bit terrified of storage. I've actually analyzed more storage than I care to because I'm very right-brained. My team can tell you. But once you get it, you've got it. So let's talk about why storage and why now.
Yeah, so storage is an incredible asset class, and the runway with that asset class is not done. And you can look at the fundamentals of supply and demand for tenancy there, kind of ignoring the investment for a minute, and it'll tell you the whole story as to why. When I got started in storage in 2016, 1 in 11 households were using storage, were consumers of storage. Fast forward only 5 years later, and 1 in 9 households are consumers of storage. In Europe, which is on track to follow American consumerism as they become a little bit more Americanized and they like our jeans and our DVDs, or whatever the modern version of that is, they're only consuming 2 square feet per capita, whereas America is currently consuming 10 square feet per capita. So there's just a lot of international runway with that asset class. There's a lot of place for the cash to go, the investment cash to go. right now, unfortunately, because 40% of the distress in commercial real estate is office, a lot of the cash that's able to escape that asset class, it's not going into hotels or retail or industrial or multifamily, which are the traditional major food groups. Alternative asset classes are having a very special moment. And so a lot of that office cash from an investment standpoint is going into storage. There is this inflation hedge that comes with storage because it's a month-to-month lease. The average length of stay in storage is 30 months, but the average length is 1 month. So you have the benefit of being able to change your rates month to month if you'd like to, but still having those sticky tenants like multifamily. So it's an incredible asset class to arbitrage that inflation hedge.
So if I don't mind saying my observation, it's interesting to me how you could raise your storage rate $20 and you don't hear a peep. If you raise a rental $20, you hear from the tenants. Like there really is difference.
Well, what's super
there.
important is that $20 on a $100 unit is a 20% increase. So to get a 20% increase on rental income is huge.
Yeah.
And that's affecting somebody's livelihood as opposed to this extraneous thing that's going on over here. So it's an incredible asset class, but because of the demand, the investment demand, right now the cash flow isn't as attractive. You've got folks kind of underwriting for 30-year hold periods, saying I'm going to capture market share right now in this moment. And so the interest rates are higher than the cap rates in a lot of your underwriting. And so the cash flow that you can experience in the first year is significantly below what you would get in a checking account. So the cash flow is just not as attractive in that first year or two. But because you can push rental rates so quickly, as much as 30, 40, 50% in a 12 to 18 month period that I've experienced, you can reverse that negative leverage into positive leverage and ultimately cash flow it in years 2, 3, 4. It's just that initial upfront requires a lot of elbow grease if you're purchasing an existing storage asset.
And I think there's a lot of those mom and pop shops that are undervalued themselves for so long, right? Mm-hmm. So there's so much upside.
There is so much. I'll give you an instance. We had a property that we purchased in 2022. So after interest rates started shifting, that we were able to push rents 40% in about 5 months. But a percentage of those rents that got pushed, the folks moved out. And so we had to do a lot of elbow grease marketing and leasing to get occupancy backfill there. So even though we were able to basically immediately turn our rates from, let's say, $10 to $14, we had all of the work behind that to get folks backfilled into that property such that we could turn what was essentially a 4.5 cap into a 7.5 cap over 18 months.
So I know you guys had also done a lot in the development space, and one thing that I'm hearing a lot of right now is essentially redeveloping a property like an old Kmart or there's multi-story warehousing and all of these different ways of doing it. Being that you've seen so many different projects in self-storage, where do you think the best way of going about it is?
Yeah, I think that if you can find a storage conversion opportunity, it is the best opportunity in storage today, possibly one of the best opportunities in commercial real estate today. But it is a big if. And I think that you see a lot of developers converting a Kmart or a Shopko, and their basis is quite high. And I've evaluated over 10,000 storage opportunities in the last 6 or 7 years. And I'd say maybe 400 or 500 of them are storage conversions. And less than 10 have been attractive to me. And I've seen a lot more than those 10 actually get executed. So perhaps my margin requirements are just, the standard is too high. Maybe I'm looking for more return for that risk of converting a storage, but you've got a super fast flash to bang. You can go from purchasing it to being certificate of occupancy, starting to lease up in 4 or 5 months. And that's just a very quick turnaround time compared to developing from the ground up. But you have that basis like you have a ground up facility, such that when you get fully leased, you've got a thick margin on it. So you've got the benefit of a quick turnaround with that thick margin if you've got the right basis. And it's that if that I don't think a lot of folks doing storage conversions are getting the right basis. I think a lot of these storage conversions are coming from retail assumptions where you can get maybe 50% higher rents for retail than you could for storage, before even accounting for the fact that you're going to lose some monetizable square footage for your hallways, for your bathrooms, your elevator shafts. And so you need to get a little bit creative. Maybe there's a cell tower lease that you need to sell off. Maybe there's an expansion in the back that you can do for roll-up units. Maybe there's like a mixed use play or something like that. But the best opportunity in storage today, right now, with the negative leverage environment, is a storage conversion, in my opinion.
So that's another great reason to do storage through a syndication, because I don't know very many people other than you that wants to look at 10,000. My storage mentor, he said, listen, you're going to have to date a lot of ugly frogs before you find your prince frog. And that makes sense. 10,000 down to this gold mine. So how does somebody find the right operator for storage? What do they need to look for?
I think finding the right operator for storage is like finding the right operator for any other asset class. First and foremost, it's about the team, right? Like, do you know, like, and trust these people? How do they treat each other? How do they treat their teams? How do they treat their investors? What are their investors saying about them? What are investor groups with closed doors saying about them? So I think if you can get to know, like, and trust the team, that's first and foremost. A great operator can turn a bad deal around. A bad operator can turn a good deal into a pile of garbage, right? So finding a great operator who has the grit to push through those difficult times. A lot of instances of a deal gone wrong is not operator error, it's market environments. So you have to have that grit, as you guys know. You're real estate investors as well. You have to have that grit to push through those difficult market environments. So I think finding the right operator in storage is the same as finding the right operator in other asset classes. If you're going to focus on a storage conversion, though, or ground up development, seeing that track record and having some type of development competency or construction competency, or ideally both, I think is preferred.
Okay.
Yeah.
Yeah. So we're talking a lot about storage, and obviously you just recently retired from a large corporation that does many different aspects of storage. Do you think you're going to stay in that realm, or what's next?
Well, I really like entrepreneurship, and I'm the worst with shiny object syndrome, right? I'm the dog that chases every squirrel and every tin roof. So I think doing storage is an exceptional asset class. But there's a part of being professional that is not just about how can you maximize your financial outcome. There's also kind of scratching the intellectual itch and learning new things and building new things and building new relationships. So I think that I will be in storage, but I don't know that 100% of my focus will be in storage in the future. I love alternative asset classes. So not multifamily, not office, not industrial, not major retail, not major hospitality. I think that if you haven't been one of those 5 things, it's been difficult to institutionalize up until maybe a few years ago. But there is this shift by consequence of syndication existing, by allowing the retail capital to bolster some of those asset classes to larger roll-up sizes, that now allows neighborhood retail, self-storage, industrial bay, IOS, flex space, small medical office buildings, boutique hotels, car washes, parking lots, these alternative asset classes to get rolled up and aggregated and become institutionalized at a faster pace than they did over the last 50 years. So I think those alternative assets as a whole are very interesting. So yes, by way of being more interested in all alternative asset classes, inclusive of storage, to answer your question, as vaguely as I can.
Well, and here's the thing, is you get a unique insight into the market. Being that you run the Best Ever conference, you get to talk to many different syndicators. You get to see all the different types of deals that are going in there. Mm-hmm. I think about, we had a girl on here who ran a firm that does cost segregation. So she gets to see all the different ways people are doing things, right? And so she talked about how she saw what was going on with trailer parks, and she started buying trailer parks, made a killing. She saw what was going on with car washes and all the front-loaded depreciation that you can do with car washes. Same thing, she was able to invest into those. And so as you're watching all those different alternative asset classes, is there one right now that's kind of piquing your interest from the standpoint? And I guess as it's piquing your interest, is it because of where you're at in life right now with your business and your wealth, or is there another reason?
I have a philosophical opinion about capitalism that we do not have to go down in this conversation unless you really, really want to. But only because I'm so tired from the Best Ever conference would you be able to pull it in.
Rant?
I've got mixed feelings.
Okay, we might be on the same page.
Right on.
Go ahead.
So I think what's interesting to me today is to help as many entrepreneurs be as successful as possible. I think the position that I had most recently allowed me to flourish and allowed me to learn a lot about myself and going through challenging experiences and to be rewarded for pushing through those challenging experiences in the right way. And it left a lot of people that I love and care about in employment. And I would love to see their employment transition to a more entrepreneurial outcome by having some of that risk of taking that step into entrepreneurship mitigated. Because ultimately, I'm not interested in being at the top of a peer hierarchy where I feel big and important about myself. I would love to bolster others to be my actual peers, if not leapfrog beyond me, so I can enjoy them in an Epicurean garden, if you will, of friendships and freedom and an analyzed life. I think there's a certain level to financial success that only has marginal gains beyond that. You know, some certain tweaks of lifestyle things that are marginally more interesting. But what makes a bigger impact, at least for me, is surrounding myself with a peer group, and not just a professional peer group, but a holistic life peer group of people who live well, enjoy themselves, enjoy the people that they're around, enjoy their thinking, their critical thinking, their exploration in this existence beyond just their professional and financial success. So I'm interested in supporting other entrepreneurs in alternative asset classes. Don't ask me to explain what that looks like yet. I'm in shadow mode with that. I'm in exploration mode. I've retired only 3 months ago, and I've been distracted with this best ever conference, positively distracted with this best ever conference for the last 3 months. So I'm more just detailing my interests at the moment, not a specific business model that I'm going after.
One thing that mentors have taught me over the years in entrepreneurship is leaders don't have a lot of followers. Leaders inspire more leaders, right? Like true leaders. So if you look backwards and nobody's following you, then you're probably not leading. But at the same time, if nobody surpasses what you're doing, are you really leading to your full capacity?
Yeah. And there's definitely, kind of getting off, if you will, on other people's success and saying, oh, I helped facilitate that. And that's interesting. But really, the core of what I'm after is to help others become successful enough that they can release the mental load of whether it's financial insecurity or success insecurity, so that we can say, okay, great, we did that thing, we proved something to ourselves, and now we can enjoy and find our ikigai and build the sandcastles that are important to us, knowing that those sandcastles will one day be washed away, no matter how long they might survive, and just enjoy each other's company while we're playing in the sand together. Because it's a fleeting existence, so let's have fun while we're doing it.
I love it. Yeah, very cool. So I would love your perspective on pre-iShare. You've seen different things hit the market. You've been in the game for a while and seen different things come about. What do you think liquidity would mean for the real estate syndication world?
Guys, it's so necessary. It's such an untapped opportunity. It's what blockchain, the promise of blockchain was supposed to be, right? Like, let's democratize everything so that everything is efficient. Right? When you look at structuring societies, the more data flow that happens, the more transactional activity that happens, the more liquidity that enters the marketplace, the more efficient things become. And real estate is probably the most inefficient data sector that exists in our financial economy. So anything that can offer liquidity, that can offer easier transaction volume, is going to add efficiencies. And every LP wants optionality. If you can think about what is the value of liquidity in an investment, right? Like you're locked up for 5 years with a targeted IRR of 15%, or you can ask for your money back in the next 30 days for a 10% investment. Which one would you take? It's a different answer for different people, and maybe you change the spread up a little bit to kind of, based on different people's interests on liquidity. But for me, I'd rather have the 10% with liquidity option in 30 days than the 15% with liquidity option, 5 years out. So to be able to have something that creates that when it's not pre-existing, that optionality isn't pre-existing, makes the GP's offering more valuable, inherently more valuable. Because if I can take that 15% and convert it into my desired 10, 11, 12, 13% with the liquidity option, it makes my offering as a GP more valuable because more LPs are going to be interested in it, knowing that that liquidity is there. And as an LP, it gives me flexibility to manage my life, my family as events. It kind of takes some of the fear of taking your money away from the old school financial advisor, RIA, wealth managers that have had to get a little bit creative to continue to show value to their clients in these last years, and allows those clients, those customers of wealth management, to shift some of their money into this private placement space with less concern because they can see liquidity. I'm preaching to the choir. You obviously know all this, which is why you're building it.
But let you run.
I'm into it.
We want
though.
other people saying the same.
I'm
message.
into it. What I will say is, in my vantage point at Best Ever Conference, I obviously get to see a lot of different companies come through. I mean, 400 plus operators have sponsored the event.
Did you see us running and running and
Oh yeah,
running
you
back
guys
and
were
forth?
working it like a circus.
There's so much interest and relief, and it was so fun. There were 7 of us there, which is unheard of for a team. And we had other people that just were like, what is your secret sauce? And it was like, provide liquidity. It's just, it's so fun to talk to people who went from that's not legal to, well, how do I do that?
Yeah.
To how do I help you? And it's really cool. And people a lot of people just don't understand it. In fact, right before Christian spoke, I was in a conference and they said, yeah, you're not going to be able to sell your secondaries. And I was like, oh, just wait for Christian to get on and talk about how to evaluate and sell your secondaries.
Well, if
so
I may
thanks
be-
for having us there. It's so needed.
If I may be so bold as to suggest a thing that your listeners probably are not going to appreciate, the thing that makes it seem like it's too good to be true is how cheap you're talking about doing it for. And I had an experience. I built a study abroad company in Costa Rica, 12 days, all-inclusive experience, like everything from waterfall jumping, zip lining, climbing to the top of a wind turbine, food, parties, bus, insurance, everything for $1,200. Does that sound like it's real? Right, it wasn't. It was a trial run. We were like, okay, maybe we'll increase it to $1,800, and nobody bought. And we finally figured out it's because it was priced like they were going to show up and have their kidney stolen. So we changed the price to $3,100, and all of a sudden it was a seamless conversion. So I've seen others try to produce this marketplace and really struggle because it's so inefficient to list and so inefficient to transact that people just don't want to even try because it's too expensive to even experiment. You guys are making it almost so cheap that it would be silly to not even just put my thing on there and just see what offer I get, right? And maybe that's the play. Maybe the play is to start cheap, get critical mass, prove it out, and then increase pricing. But it probably seems too good to be true because of how cheap it is.
Yeah. And I appreciate you saying that. And, definitely there is a play there, right? Because if we can get enough deal flow, the data to us is very important. Obviously we have a fund that is, behind this that wants to buy these secondaries. Mm-hmm. So we want to understand just as much as anybody else, what are these going to trade at? I mean, that's the first question I get every time I explain it to somebody. And usually the question isn't what are they trading at, it's what's the discount, right?
Right, yeah.
And we really believe when this is an efficient market, there doesn't have to be a discount necessarily when you're selling those secondaries. But it all is also interesting. I was just listening to a book today, I think it's called Influence, and it was talking about this principle that you're saying. And the story that he used was a vendor that was selling jewelry and couldn't get them sold, and kept marking them down. Left a note for her assistant and said, "Mark these jewelries down by half," and headed out of town. The assistant saw it as 2, so she times it by 2. By doubling the price, they all sold out. And it's kind of that perception that many of us use this, these key indicators of, well, if it's cheap, then it's not worthwhile. Now, hopefully we don't get that perception with what we're doing, because what we're doing is bringing value, to both sides of the coin.
Well, we're so thankful for our CEO, Michael Anderson, because this is his vision. He was in sponsorship forever and actually was doing sponsorship before sponsorship was even a word. And he just said, I want to give back to the community. We need to provide so much value that it just floods the community with knowledge. And yeah, we just start slow. We're literally in our beta mode of this of the listing hub and just about to release what I think is a monster AI driven and AI assisted to help people get all the data and upload their listings and just make it so easy, and it's still going to be at a really affordable price. And so,
and the key for us, I really believe, is we understand that if you lead with something and you're chasing, the highest price possible up front, and somebody doesn't have a good experience, you don't get to have a second interaction. Our goal is to provide way more value than anybody is paying us for all the different aspects of our business, because ultimately we believe that will sustain us long term, and then we can figure out what market rates are, over time, with people that are committed to us because we led with value in the first place.
Yeah, no, I get it. Build up critical mass by flooding everyone with value, and then figure out what the price point is that's appropriate for the market.
Yeah.
Fair.
I'm going to take us back to the Best Ever Conference for a minute because
Yeah.
many people that are watching this may not even know what it was. I know last year, we kind of got reprimanded by Neil Bawa because we didn't have a presence at your event.
It's the appropriate word from Neil. Reprimand.
Yeah. if somebody is seeing this and they're thinking they're either in real estate syndication, they're wanting to be into syndication, what are some things they should think about doing to best maximize their experience at the Best Ever Conference?
Well, if somebody's thinking about being in real estate syndication or exploring that, I would actually recommend not checking out the Best Ever Conference. And I know that sounds counterintuitive. Why wouldn't I want to sell as much attendance as possible? We plan on growing that conference to a certain point and then sealing it off. We're not looking to have a stadium filled with people 10 years from now. If you are looking to get into real estate syndication, I would recommend continuing to listen to shows like the Fundication Show, see other podcasts, read some books, check out Bigger Pockets, check out bestevercre.com, which is a forum for content and information, because there's this much cheaper ways to kind of get tickled with this information and to learn, is this something that you really want to explore? Once you have gotten some experience under your belt, a couple of trial runs, maybe you're using your own money, some friends and family money, doing a couple of deals, and you're ready to start scaling, optimizing your approach, and you're really committed to this as a business, then the Best Ever Conference makes a lot of sense. We actually price it and put content out on stage to try to dissuade the folks who might not be able to consume as much value. You can't be everything to everyone. So we don't want to be the place for people who are trying to figure out how to get started to go. There's other conferences for that. There's coaching conferences. There's the Bigger Pockets conference. You can find wonderful content for that. Once you are feeling a bit disillusioned by the people around you, that they're still trying to figure it out and maybe they're not as helpful to you, and you're looking to be the person in the room that maybe you want to feel the dumbest or the poorest and you want to be surrounded by smarter, richer people, the Best Ever Conference might be an appropriate place at that point. Yeah.
Do you have the demographics or any understanding of what the average assets under management are for syndicators that are attending the conference, and what is your ideal syndicator that you would love to see there?
Yeah, we've done some surveys, and so we've got some estimated results, not factual, but statistically estimated results. And so about 96% of our attendance has done at least one commercial deal in the last 6 months, either as an LP or a GP or fund manager sitting in between. I don't know the average AUM. I could give some estimation, but I know that for sure our total AUM in representation at the conference is over 50 billion. So it's a real relevant portfolio, if you will, of companies that are present. And I know that the money walking around the room is getting close to $1 billion. We said a couple years ago it was 400 million. I had at least 2 conversations that just between the two of them, I know that there was at least half $1 billion. So I'm going to say that very conservatively, around $1 billion of unplaced capital walking around the room. And in terms of the various sizes, you don't really see folks there that have maybe a few fix and flips or a dozen single families. It's more, maybe of the operators, 50% are in that 10 to 100 million range, another 25% are in that 100 to 250 million range, and then the other 25% range from 250 to 5 billion assets under management.
Very cool.
Yeah,
those are great statistics, and I think it gives somebody a good idea of what they're coming into.
Broad strokes, not.
Of course, yeah. We're not locking you down to the science of it, but it's a good to get your perspective of what you see it.
Data integrity is too important to me not to couch my statements. So.
Love it. Very cool. Well, I know we're going to be getting to dinner soon. I really appreciate you spending some time with us.
Wow.
You were the one that reached out to me when we had come into this conference, and I'm grateful for this interaction, grateful for the show.
Yeah, to you and your whole team.
Yeah.
You just
Are there any parting words that you can give, our listeners?
Yeah, if you'd like to check out the Best Ever Conference, you can go to bec25.com. It's a great show. It's a great time. We have nothing to sell. We just like to add value, diversity of thought on stage, community, networking, investing, and partying. And so if you are the right type of person, we'd love to have you join our community. We're looking to build a membership group that offers insurance services, recruiting services, and property tax appeal services. And we're building an investor community as well to take advantage of all the operators that come through. So
that's a whole other episode.
Yeah. So looking forward to speaking with your listeners, and just keep watching Pre-iShare, because the secondary space is one to watch.
Absolutely.
Thank you.
Thanks for joining us, everybody.
Bye, everyone.
Psst.
passive investors. We've unlocked the #1 secret to finding performing passive real estate opportunities. We want to bring this secret to investors like you. If you're ready to build wealth with real estate like the ultra rich do, click below to find out more.